In this video, we explore the timeless wisdom of Alexander Elder, legendary trader, psychiatrist, and author of the classic Trading for a Living. His insights have shaped generations of traders, redefining how we think about psychology, discipline, and risk management. From his early struggles in the markets to writing one of the most influential trading books ever published, Elder proves that lasting success doesn't come from hot tips or secret indicators. It comes from the right mindset, a sound method, and strict money management, all tied together by the discipline to treat every trade as part of a lifelong experiment. From the ComLucro archive, we've selected 7 of Elder's most powerful lessons, a blend of psychology, practical tools, and timeless truths designed to help traders survive, grow, and thrive. And it all begins with Elder's most enduring message: your trading journal is the most valuable book you will ever write.
I began learning how to trade, gambling, I would say, in my 20s. And I really didn't know what I was doing, but I was reading all these books and indicators, psychology, GAN, everything. And eventually things started settling down. And I began writing this book. Basically, I was writing it for myself the way I was several years before I wrote it. Everything organized and everything in order. I don't have to go to 50 different books, but everything in one place. And that's how my first book, Trading for a Living, came about. It became a big international bestseller. I never thought of success, I never thought of money. I wanted to write the best book possible. And that book is now over 20 years old. It was still a bestseller as early as this year. I finally agreed to my publisher's request to write a new book, to update it, the new Trading for a Living. And I thought it would be a quick project. 3 months was my time budget. Took 18 months and just completely major amount of work. And it became a completely different book. Today we'll go very quickly through the book. Successful trading is based on, I used to say, 3 M's: mind, method, money. Mind is how your psychology is organized. Method is how do you decide what do I buy and what do I sell. And money is your risk management. Well, I think there's a 4th M, and that's management in terms of record keeping. The quality of your records ties it all together. Your technical analysis, your psychology, your risk management. You've got to keep records.
The foundation of Elder's message is clear. No external course or guru can replace the power of documenting your own trades. By keeping detailed records of profits, losses, and the emotions behind them, you build the ultimate mirror for your strengths and weaknesses and the roadmap to consistent improvement. But awareness without discipline is fragile. In the next clip, Elder reveals how even talented traders can sabotage themselves when risk management is ignored, and why consistent survival matters more than short-lived wins.
He won 5 weeks in a row, but blew up his account in one bad trade. Why?
We have a weekly competition for the best pick of the week. And the guy who wins the best pick of the week writes a report, how I won my gold. So we have this group of elite traders who are competing for the best pick of the week. We have a guy who, since the beginning of this quarter, October, November, now the first week of December, won 5 golds. And he's being thrown out of the group at the end of this quarter. This is why the black line is his equity curve. So he starts from 0 at the beginning of the quarter. And right now, at the right edge of the screen, he is down 15%. There are 13 competitors. There are 13 elite level traders. And the guy beats everybody half the time. If we go to the website, and this is a Spike Trade website, then right at the front page is his report, how he traded last week, what indicators he used, and how he made a 7.64% profit in 1 week. And he's being thrown out because his equity is here. So what's wrong with this picture? How come? There's no risk management. This loss which he suffered last week, he wants to win. So he's gaming the system. He buys a $5 stock. The guy buys a cheap stock, so he's waiting for a big swing. Unfortunately, those cheap stocks, when they swing the opposite direction, they're just as bad the other way. So he is profitable early in the week, and on Friday, the stock is called to open lower. So he pulls his stop. He doesn't want to be hit on the stop. And the stock does open lower and continues to slide, and by the end of the day, he's down 20%. So what is it? Lack of knowledge? Lack of understanding? It's lack of risk management.
Elder makes it crystal clear. Even talented traders can destroy themselves when they ignore risk management. No matter how many short-term wins you stack up, without discipline and respect for stops, the final outcome is always the same: a falling equity curve and mounting losses. But protecting your capital is only one side of survival. The next lesson goes deeper into mindset. Why isolating yourself from the noise of the crowd and keeping your trades private until they're closed can save you from the dangerous pull of herd mentality.
Some years ago, I became friendly with this fellow, Joe Granville. He was a fascinating guy. He really put volume on the map. And we'll be talking about volume later today. But he used to move the markets. He would speak and the Dow Jones would jump 40 points, which was a huge number in those days. In any case, Pat and I went to visit him in Kansas City a couple of years ago. He was 90 and was complaining that the management wouldn't give him a 15-year lease on his apartment. He got only a 5-year lease. In any case, he only turned on his computer when it was time to send out his newsletter. Otherwise, he watched his quotes on the TV, on CNBC, on TV. You know, where they have the tape running. So he had a TV set with a towel over the TV and sound turned off. And so all he could see were the running tape below the picture. You have to isolate yourself from the crowd. The remedy from being swept up in market hysteria is make decisions alone and don't talk your book. Talk your book meaning don't tell other people what you have. It's not a good idea to share what you have, because if you tell them, I think Tesla is going up and I bought $215 and it's now $225 and then Tesla goes down to 214 and 205 and your friends start calling and saying, hey, what about the Tesla thing? Oh, it's a pullback, it's a buying opportunity. Now it's down to 195. What about the Tesla? It's a pullback. Friends stop calling. Tesla is at 170. And you realize it was never a buy, it was a sell from the beginning. Why didn't you see that? Well, because you told all your friends it was a buy. Now you're protecting your thing. So don't talk your book. It's perfectly fine to have friends and to discuss your trades with friends after you close them.
Elder's lesson here is sharp. Survival depends not only on protecting your capital, but also on protecting your independence. When you let the crowd's noise or your friends' opinions shape your trades, you stop thinking clearly and start defending your ego instead of your account. The market doesn't care about your story. It only responds to price and discipline. That brings us to the heart of Elder's teaching. Charts aren't just lines and candles. They're the footprints of real decisions made by buyers and sellers. In the next clip, Elder explains what technical analysis truly is and how every single dot on the screen reflects the consensus and the battle between bulls and bears.
We're starting to move towards technical analysis. And the question really is, what is technical analysis? What are these charts? Well, the reality behind these charts is that they're people. Behind every single dot on the screen, there are actions of two individuals. There is a guy who bought and a guy or a gal who sold. Right? There are two people behind every trade. And you can, oh, what about algorithmic trading? Well, those algorithms are programmed by someone, aren't they? When we're looking at the charts, we're looking at footprints. And those footprints can be very messy or they can be very organized. Charts can be trending or charts can be caught up in congestion zones. Very easy to see all of them in the past, very difficult at the right edge. But prices are the footprints of bulls and bears. So when we analyze charts, we analyze mass behavior. This is the formula, really. This is the formula on which I think technical analysis stands. Each price reflects a momentary consensus of bulls and bears. Since we're talking about Tesla, let's take a look at the Tesla chart, TSLA. We'll look at the Tesla chart. Let's go here, 5-minute chart. Each body represents 5 minutes of trading. We can slice it even thinner. We can go to 1-minute chart. Oh wow, having a nice rally in Tesla here. There was no rally on the daily chart. But you slice and dice, and eventually that's the danger. You slice and dice, you end up seeing what you want to see. So you have to have rules for your slicing and dicing. But on this 1-minute chart, I just want to say to you, behind every single dot, never mind the bar, behind every single dot, there are two individuals. There's a buyer and there's a seller. So each price is established in balance, in this balancing act between buyers and sellers and undecided traders. If you're in a mood to buy or to sell short Tesla, then you're a participant in Tesla, even though your trade isn't there. The people who are buying and selling it know that they better move fast, because if they don't move fast enough, you're going to jump in and take away their bargain. And so every single dot on your screen represents actions of two individuals surrounded by the market crowd. And so each dot is a reflection of the consensus of the entire market. So each tick represents market consensus for the entire crowd at that time. And when you're buying or selling, you're actually being very courageous, because the entire market crowd said, this is worth so much. And you're saying either, I think it's worth less, or you're saying, oh, that's cheap, let me buy more. So you're arguing with the entire market crowd.
Elder reminds us that charts aren't just abstract lines, they're living records of human behavior. Every tick on the screen is the result of two people making a decision, and every price reflects the temporary balance of fear and greed in the crowd. To trade successfully, you need rules that keep you from slicing the data until you see only what you want. True technical analysis is the study of mass psychology written in price. But reading the crowd on a chart is only half the battle. The other half is mastering your own psychology. In the next clip, Elder explains the difference between individual psychology and market psychology, and why the search for entertainment in trading is the fastest path to failure.
I think market psychology is divided really into two huge areas: individual psychology of trader and mass psychology of the markets. In terms of individual psychology of traders, I think that all of us come to the markets with a wonderful goal to make more money than we can get from a treasury bill. But along the way, most of us lose focus and we start trading for entertainment. I think that financial markets are the most entertaining places on the face of this earth. It's like a horse race, card game, chess game, all rolled up in one, and it goes 24/7. You can always find action. And so people who are bored, stressed, hate their lives, they escaped into trading and they're immensely entertained by it, but they don't make money. When you want to be entertained, you have to pay. You cannot make money. Successful trading is a little bit boring. And that's why my best advice for somebody who wants to become a cool, calm, disciplined, successful trader is keep written records. I hate keeping written records. I'm bored by written records, but that's what makes me into a serious trader.
Elder drives home a crucial point. Trading is not meant to entertain you. The market can feel like the most exciting game in the world, but if you approach it for thrills, it will drain your account. True professionals accept that successful trading is often boring, and that keeping written records, however tedious, is what transforms discipline into profit. But personal discipline is only one side of psychology. The other is learning to read the mood of the crowd. In the next clip, Elder shows how markets swing between happiness and despair, and how tools like the VIX and put-call ratios can reveal when complacency is dangerous and when fear creates opportunity.
When markets are happy, that's when they top out, and that's when they go down. When markets are depressed, that's when sellers come out of the woodwork and everybody sells the markets, and eventually there are no more loose shares to be sold. And so depressed markets bottom out. We have indicators which help us identify happy markets and sad markets, depressed markets. There is put-call ratios, commitment of traders, also not to be forgotten VIX. When VIX is low, go slow. When VIX is high, it's safe to buy. VIX is a fear index, so when VIX is high, fear is rampant, that's a safe time for buying. When VIX is low, the crowd is complacent, and that's a dangerous time. When a market blows out of its channel, when a market creates a bearish divergence, when you hear this happy news of IPOs, well, that's a happy market, and that's when I start looking for shorting opportunities. When a market is depressed, when it falls out below its lower channel line, as the stock market has done about a week ago, when the news are gloomy, that's when I become interested in creating a shopping list. And by the way, one of the troubling things about the market today is that after this decline we've had since late April, VIX has never picked up. VIX is still at 20. The crowd is complacent, the crowd is not fearful, and that's why I'm quite cautious about what's happening today. I don't think we have seen the bottom of it yet.
Elder's warning is clear. When the crowd is euphoric, danger is near, and when fear dominates, opportunity is often just around the corner. Reading the market's mood through tools like the VIX or put-call ratios helps you avoid complacency and prepare for moments when others are blind. But knowing when the crowd is wrong is only half the challenge. The harder part is resisting the urge to join them. In the next clip, Elder digs into the psychology of stress, explaining why traders who rely on chat rooms or outside opinions end up sabotaging themselves, and how true independence is the only path to wisdom in the markets.
Mass psychology of the market. The general human tendency is that we huddle under stress. What do you think? So is Tesla going up or is Tesla going down? Markets provide plenty of stress. And the tendency that we have, we look at what other people are saying. But the difference between the market and many other areas is that market is absolutely hostile. If you drive and accidentally swing into another lane, the guy who is driving behind you is going to honk at you, but he'll hit the brakes because accidents are expensive for both parties. In the markets, you swing into your own lane, somebody will take your door off of your car together with your arm. So asking other people what do I do is probably not the best idea in trading. One of the worst things that traders do, they put in a trade and let's say the guy buys Tesla. He goes on the internet to see what other people are saying about Tesla. Well, is that part of your trading system? I mean, you decided to buy when the moving average is up and prices are near the lower channel line, whatever you decided. You exit when prices hit the opposite channel line, but the question is, does looking at the chat rooms figure in your plans somehow? So it's a very dangerous thing, looking at what other people say. What we do in Spike Trade is based on a book that shocked me years ago. There is a very good financial journalist here in New York. His name is James Surowiecki. He wrote a book called The Wisdom of Crowds. And I saw that title and I said, Wisdom of Crowds? I thought crowds were dumb. Well, it all depends on how crowds are organized. The intelligent crowd is the one where people take decisions independently. And then the people who run the group just kind of bring those decisions together. In Spike Trade, where people compete for the best pickers of the week, the site goes under embargo on Friday at 5 p.m. It's under embargo right now. It's going to open at 3 o'clock, at 3:15 on Sunday. So everybody submits a pick for the competition, not knowing what other people are submitting.
Elder makes it clear, piling on more indicators and complex systems doesn't make you a stronger trader. In reality, complexity often clouds judgment. The traders who last and thrive are those who strip their process down to what truly works. A few reliable tools, clear rules, and flawless execution. Now that you've seen Elder's most enduring lessons, from psychology and discipline to risk and simplicity, let's bring them together. Here's a 7-step framework drawn from his wisdom, designed to help you build a trading approach that's focused, resilient, and built to last. Step 1. Write your own trading book. No outside mentor or indicator can replace the lessons in your own history. Keep detailed records of trades, profits, losses, and emotions. Your journal becomes the most valuable book you'll ever write. Step 2. Respect risk above all. Talent and winning streaks mean nothing without discipline. Ignore stops or gamble for quick glory, and your equity curve will collapse. Survival is the first victory. Step 3. Stay independent. The crowd's noise is dangerous. Don't talk your book, don't trade for applause, keep positions private until they're closed, and protect your independence of thought. Step 4. See the footprints. Every bar, every tick is the record of two people making a deal. Charts are not abstract, they are the footprints of bulls and bears, and they show the battle of mass psychology in real time. Step 5. Trading is not entertainment. Markets are thrilling, like a 24/7 game, but those who come for excitement pay for it. Real trading is calm, even boring. Discipline and record-keeping turn boredom into profit. Step 6. Read the crowd's mood. Euphoria signals danger, despair signals opportunity. Use tools like VIX or put-call ratios to measure fear and complacency and position yourself where others are blind. Step 7. Simplify your tools. Complex systems cloud judgment. The traders who last focus on what truly works, a few reliable tools, clear rules, and flawless execution. So if you're serious about sharpening your discipline and protecting your edge, the Psychology of Trading playlist is your next step. It features insights from David Paul, Tom Hugard, Alexander Elder, and many other world-class traders, all revealing the habits and mindsets that keep them profitable. Because in trading, protecting your capital isn't just part of the job, it is the job. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro Trader community right here on YouTube. It's a way to support our work and a smart investment in your own development. Thanks for watching, and I'll see you in the next video.